Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on September 23rd. My name is Ian Saunders, and we are joined as well today by David Clark. David, coming in here to another podcast this week and another sea of red to look at on the screen.
That it is. I feel like I had gotten that out of my system last week talking to Katie, but here I am again.
It's been rough to look at. I mean, luckily there is a little bit of green. I mean, just looking at current intraday data, we're seeing the S&P 500 at the time of this recording. Just a reminder, we are recording this on Thursday afternoon. So market's been moving around a lot. We're recording this Thursday afternoon. Podcast going to be coming out on Friday morning. But at least at the time of this recording, the S&P is down almost 1% right now. Small caps getting beat up quite a bit worse, down to 2.3% right now. A little bit of green on the screen. We see healthcare is currently positive on the day, up a little over 0.5%, and energy is just slightly positive, up 0.17%. But everything else is doing quite a bit worse. And we've seen this follow through with market action today on Thursday off of some of the action that occurred yesterday after the Fed announcement. We saw the rate hike come in at 75 basis points as expected. Some people were thinking it might be 100 basis points, but it came in at 75. And the market went on a little bit of a roller coaster ride, took a pretty big dip. And
that's
then,
one way to refer to it. Yeah. And about the only thing in the green today is rates, looking at that 10-year yield chart. That's the only green I've seen on many charts today.
Yeah. I mean, I think you could refer to this whole year as a roller coaster ride at this point. I mean, it's been a lot of roller coaster on the way down right now. Hopefully maybe we'll get some climbing back up the slope coming forward here.
Yeah, we'll see if we can get there. I mean, we've seen some of the action with like the S&P today, looking at that chart, coming down to that 3750 level, still holding above the July low on that 25-point per box chart of 3725, but also we're still keeping an eye on that June low of 3650. And really, we saw small caps have gotten the brunt of a lot of downside action today, but really no index chart has been unaffected today by especially looking, this being Thursday, looking just today's intraday action. You've seen a lot of these charts impacted, and even from there we've seen indicators impacted too, because I think you were mentioning earlier about the weekly momentum or monthly momentum, one of the indicators looking at the
Yeah, I think that, we're seeing a lot of stuff get to really washed out territory, right? A lot of these indicators are getting down into low levels. But the indicator, the S&P itself is kind of creeping towards washed out. We were negative 60% from a weekly overbought oversold perspective through market movement on Wednesday. We come in at the time of this recording here on Thursday, and we're still sitting a couple boxes down if you look at a 20-point chart for the S&P. So it's going to be a little bit deeper into the oversold territory, but we're only at an intraday reading of negative 66% at this time. So that's not really what we would consider to be heavily oversold, right? It's just a little more oversold than you would like. Like you said, we see pretty strong support down there at that 3740 mark. If you're looking at a 20-point chart, got there a couple times in July. And then obviously next support from there is going to be that June low down there at the 3620 level, or 3640 level, forgive me. But like you said, some of these indicators have ticked down. Momentum SPX or MOSPX, which is measuring the percentage of stocks in the S&P 500 that have positive weekly momentum. This indicator has seen a lot of back and forth movement throughout the year. Potentially go from 0 to 100%. It got down to low levels earlier this year, fell down to 16% back in May, and then rallied all the way back up to 94% by the beginning of August. Talk about a coast to coast move. But then turn around and turn right back around, head in the opposite direction. And it's fallen all the way back down to a reading of 4% with movement through market action on Wednesday. So it's getting pretty low. It can go lower technically. You could technically have it go to zero, right? You could have no stocks in the S&P 500 be trading with positive weekly momentum, but it can't go a lot lower than it is right now.
Not too much lower. In all hindsight, looking at that coast to coast move, we really can kind of look back now and say it was somewhat of a bear market rally, but now we're looking to that we've shaved roughly half, I believe, of what a lot of the indexes have done. So, we're looking down to those potential support levels further down. And even further changes that we saw coming in today was we saw the cash bogey check within domestic equities fail following last night's action. For those not familiar with it, it's just a 1-for-1 RS chart in which we take a asset class proxy. It's an in-house Dorsey Wright asset class proxy. Compare that against cash, the symbol being MNYMKT, on a 3.25% RS chart. And we actually saw that reverse down into O's, favoring cash. And actually, if you look at the inverse, you saw that one reverse up into X's, favoring cash as well. So really got some confirmation from the vice versa or opposite relationship also. And then further confirmation was witnessed when we saw the money market percentile rank on the asset class group scores points jump 30% overnight from roughly 42 to 77% as of Wednesday's close. And when you look at a lot of that, you saw quite a few notable groups. The two biggest ones to me that were pretty notable, obviously, we saw all U.S. equity diversified fall below U.S. money market. And then from there, you also saw that low vol equity group fall below U.S. money market, kind of being the two groups that had shown some strength, had built up some momentum as far as score increasing, but really didn't see too much impact to score. Just really saw a lot of those RS charts of, U.S. equity indexes versus cash move into column of O's, favoring cash. And that was really where we saw a lot of this jump with many of the cash indicators. Now, when you look at the Dolly details page and you're checking out the cash percentile rank, we do see that it increased up to 30% after being right around 24, if I'm not mistaken, yesterday. But I have to look back to double check that. But we see that increase above 30%. And we would see that light change with a move above 33% to a cautionary light, sort of giving us the idea to, again, exercise caution. Not that I believe we need anything else at this point to tell us to exercise caution, but it would be something else that would kind of add confirmation that we would be doing the right thing as far as looking at a lot of these indicators. And, we still, the one challenge here, and this is something we were sort of talking about before we started, is when you're looking at some of these positions right now, you're looking at higher attribute stocks that may be taking out a level of support, but still maintain some other level of support below, which is a positive in some fashion. But
yeah,
it also can be a bit of a challenge as far as trying to manage things right now because we're getting such volatile swings. So, looking at a lot of charts, we're looking to try to keep up with that support level, those support levels on many of them.
And before we dive into some of the charts, though, David, I think it is. In looking at some of these indicators, you mentioned the bogey check, right? It's flipping back down. It's the third time this year that's happened. The MMPR going back above 70s, second time this year that's happened. We've seen a lot of this stuff and happen earlier in the year. We get the rally, the bear market rally, like you said, and now it's flipping back in the other direction. Like I said, I think caution is kind of the name of the game here. I think we can dive into some of these charts, but I think that point in looking at some of these indicators that, they are at what would historically be, what we consider to be extreme territory. Right. If you told us a year ago that we would have had some of these moves multiple times in a year, there's not that many other market environments that we've seen some of these indicators move that many times.
And in many conversations, you're referring to 07, 08. So,
right.
There's almost this skepticism that we don't want to believe that it's going to happen again. And the thing is as we always talk about, no market environment is the exact same. So, we're seeing bear market activity further downside, but this is a different environment.
And I think that different environment, exactly right. There's a lot of other stuff going on underneath the hood in that environment than there is now, and there's stuff going on now that there wasn't going on there, like potential kind of war going on. Right? There's a lot of different. Every market environment's different, as is the typical pundit terminology that we do say as well. But looking at some of these indicators, like the momentum SPX we touched on, the 10-week, and there's another one, 10-week SPX. We're looking today at some intraday readings. They're down getting close to 10%. You don't see these get that low and hang around at those low levels for a real long time, right? You would expect a bounce from these levels. Something to look toward, but it's just a matter of can that bounce be sustained? I think is the biggest thing that we're looking toward. And I think diving into some of these charts, like we're looking at, just because you've seen some names break through notable support. If they're maintaining favorable attributes, if they're looking okay, it's not that just because it broke through notable support, you want to go and sell out of all of it. So maybe you're not just buying into it now, right? I think that's an important thing to keep in mind, is that given the washed out territory, we're likely to see some kind of movement higher, but it's just a matter of how much that movement higher can go. And And I think, David, looking at, I mean, we had a slew of charts. I mean, some of the larger, more well-known Dow stocks that saw some pretty interesting movement, right?
Right. And really kind of, two that we want to talk about really quick that are just moving to new lows, that being 3M, MMM, and Nike. We actually see 3M moving below 114 on its chart, taking out the prior low from this month, moving to new 52-week low. Now, the attribute for that stock is a 0 for 5, so not really giving you much case to hang on to it. Somewhat of a similar story for Nike as well. I mean, it's a 1 for 5. It's now taking out that support there at 100, moved to new 52 weeks lows as it's fallen down to 98 on its chart. And then from there, most of these are just sort of keep an eye on them. They might be testing or monitor or have taken out a near-term support level, but still have favorable attributes. And for the most part, you would probably still hold them unless you were just looking to raise more cash for the ability to redeploy. But one of the stocks that I think is interesting right now is Visa, being a 4 for 5, has come down to test support at 186, has additional support there at 180. So you've got some further support levels that you could look at. And truthfully, Visa would probably be a fantastic covered call option because it's just been trading sideways for almost a year and a half now. So it is one that you could look to maybe generate some short-term income off of just by selling some calls. But, two of the positions that really intrigued me as far as our discussion of monitoring support, considering attributes, but really kind of making your determination, looking at where you may have support levels left. And one of them that's interesting to me is Boeing, BA. Today gave its 5th consecutive sell signal, breaking a double bottom there at 140. Still has support at 136 as well as 132, but then after that, looking down to 114. So you could definitely make a case if you've bought it near term to potentially sort of hang on because your cost basis might be okay. But looking cost basis is always the key.
That 132 support, I mean, it's pretty notable, right? I mean, it hit there. If it got down to that level, it's going to be the 4th time since June that it's hit that level, right? I mean, it is a 2 for 5, like you said. I mean, it's on 5 consecutive sell signals. Not a great sign. But I mean,
you a bit of a mixed bag as far as things.
I mean, we would certainly classify it as like a sell classification by nature of the low attribute reading. Those with obviously Boeing's a big name. A lot of people have that. I mean, you can kind of look towards that 132 level is kind of a more line in the sand demarcation, because then if you're moving from there, like I said, you're back down at those June lows. But I mean, it's still pretty weak. I mean, we'd like to see some more notable technical improvement, especially if you're looking for areas to jump into if the market does rally. I don't know if I'd be throwing Boeing at the top of the list.
Yeah, possibly not at the top of the list. But my last stock we'll take a look at, and this one's going to be probably the one that we both just sort of go, hang on to it right now because there's really not much that it's given you otherwise, and that's being American Express, AXP. It's a 4 for 5. It did break a triple bottom and move below its bullish support line today, so it will drop to a 3 for 5, but still has support there at 136 as well as further support at 134. So still some pretty significant support in the mid 130s. And really in June and July, that's where you saw it start to bottom out as well. So it's one that you would probably say hold at the moment and keep an eye on that support level because it's a higher attribute name. And then if it was able to reverse back up, give a buy signal, then you might look to it as a possible one that you would add as long as it's able to hold above that support level. But I think moving forward for the next couple of weeks, because in a lot of the studies we've done with the indicators, we found that, the 1 to 2 week kind of can be a little bit mixed with some of the indicators coming off the bottoms, but really we look to those 3, 6, and 12-month time frames as being sort of the long-term focus and what we try to really, really grasp onto, if you will, hoping that we're going in that direction. But even then, keeping an eye on support levels on these charts, obviously bearing in mind what your cost basis is, there's a lot of implications to look at. But the thing we would say is continue to monitor them, and there's not much else. That's about all we can leave you with.
I mean, I think monitoring is the key there. And we can try to help you out with some of that with like setting alerts in the charts. I mean, this is going to be the time that you want those alerts to be set, right? I mean, with the markets moving around, like we saw a 50-point swing in both directions within 20 minutes yesterday. I mean, it's a lot going on. So it's setting some of those alerts, letting the system do a little bit of that work for you. So you just simply sit there and wait for an email instead of having to refresh chart pages like we do all day. It would probably be a prudent route to go. We're doing it so you all don't have to. With that, I mean, David, we could sit here and keep talking about charts stocks. I mean, we could go through it for the rest of the day, probably the next into tomorrow if we need to.
Until we could even cover the ones that are just breaking down minute by minute, almost do a live feed of it in a way.
Right.
But,
Yeah. But like, I mean, there is going to be certainly stuff to look toward. And like we said, I think that looking at some of these indicators, I mean, they are low, and with move, when they're at such low levels, I mean, it can go to 4% down to 2%, and that's cutting in half from the amount of stocks that were previously kind of holding up, right? And so that move's going to hurt. It's going to feel a lot worse, but they don't typically hang around at these low levels for prolonged periods of time. Is something to keep in mind. And so waiting for some of these, like David was saying, I mean, keep an eye on these support levels. And if we do get some semblance of a bounce from this kind of washed out positioning from an indicator perspective, could be some opportunities here. Just a matter of maintaining those support levels as we're moving forward. So with that, I mean, I think, David, that wraps up most of the charts we're looking to cover here this afternoon. So we'll go ahead and wrap things up. Thank you all for tuning in, and we look forward to talking to you again next week.